Well, hello, and thank you for joining us today. My name is Nathan Shipley with the NPD Group, and we're excited to bring this mid-year webinar to you. We're going to talk through performance through June of 2016 of the Automotive channel. A couple of quick housekeeping items before we get into the details of what's been going on the last few months. This presentation will last approximately 30 minutes. We will not be accepting questions and answers due to high attendance of this session. But if you do have questions about this, please feel free to reach out to your account manager or NPD representative after this call. Our retail tracking service, which is the service that we're using for most of the information presented today, it tracks 29 front-of-store categories, but it excludes application-specific parts and all commercial volume. So the category types that we're tracking include things like wiper blades, batteries, filters, chemicals, motor oil, etc. Application-specific parts or behind-the-counter parts like starters, alternators, etc. We're not tracking. And then commercial volume for any category we are not tracking. With all of that said, we estimate that our retail tracking service covers roughly 80% of the U.S. DIY retail market. And the time period that we're looking at today for this analysis is year-to-date June 2016, unless I noted otherwise. But the general theme for this whole presentation is the first 6 months of 2016, how has the industry done versus prior periods. The objective of the presentation today is to communicate macroeconomic trends impacting the retail auto parts channel. So from a macro perspective, what's going on and how is it impacting growth or decline in certain categories? Again, looking at the first 6 months of the year, and ideally you walk away from this session with understanding the bigger picture of what's going on in the market as it relates to your own categories, so you can have a better understanding of just what's going on in general with your retail partners, other categories that are in the store with your products, etc. A couple of general observations before we get into the details. The first area we're going to look at is miles driven. So May 2016 set a new record high for miles driven. And each month that we've looked at here recently, especially in the last 8 quarters or so, the miles driven number has been a new record high. With that said, on a per capita basis, we are at a level that we were at almost 20 years ago. So overall as a country, there are more of us driving, yet as individuals, we are driving less. The 12-month growth rate through May 2016 is at 3.4%. So the growth rate for miles driven continues to be very healthy, but that growth rate is slowing down. There's been an acceleration in the rate up to this point, but here in the last 2 or 3 12-month ending periods, we've noticed a bit of a pullback in that growth number, and we'll get into the details here in a few slides. As far as gasoline prices go, gasoline prices continue to remain cheap, especially relative to prior years. So because of cheap gasoline prices, demand continues to increase. As demand increases, with gasoline prices being cheap, retail spending on gasoline prices continues to decline. It's been down multiple years. So as consumers, we continue to save money at the pump versus prior years. The weather. The first 6 months of 2016 as an aggregate, it's the third warmest period on record going back over 120 years. Number 1 and 2 in order are 2015 and 2012. So here in the last 4 or 5 years, we've had the 3 warmest 6-month periods, again, looking back over the last 120 years. For precipitation, we haven't had any real extremes. It's an average year so far. So when we rank the precipitation amounts for the country, it falls right in the middle of that 120-year ranking. So a lack of extremes on cold weather and rain have had an impact on our channel, which we'll get into. And then from our retail tracking service, we can look at the average selling price of all the categories out there. And overall, when we average all products and all categories together and look at the average selling price overall, we've actually seen the decline in the average selling price. And the majority of the categories that we're tracking saw a similar decline. There's a couple of things influencing this that we'll look at, but one of the things influencing this is a change in the mix of what's being sold out there. So we've got some categories where we'll look seeing more economic products being sold in lieu of more premium products, so cheaper priced products that are driving this average selling price down. So let's look at miles driven. miles driven growth continues, but we are at an annual per capita rate from almost 20 years ago. So if we look at the trend of miles driven, this is a rolling 12-month number going back to the early 90s, you can see this general upward trend that we've seen. Again, this is going back even before the early 90s. We saw a peak in November 2007, what we call the pre-recession peak. And after the recession hit, 2008, 2009, and as gasoline prices started to go up, we saw a decline in the number of miles driven every single year. Then we get to late 2014, gasoline prices started to trickle back down a little bit, and we see a corresponding lift in the miles driven number, and we're at where we are today, the high, as I referenced on the first slide, of May of 2016. And when we compare the actual numbers, the 12-month ending May 2016 versus the pre-recession high in November 2007, we're driving 133 billion more miles per year now than we were back in 2007. That's a great story for our industry. When we look at it on a population-adjusted basis, so a similar chart going back to the early 90s, but I've adjusted this for the population, and I say population, this is age 16 plus, so presumably all these people 16 plus are drivers. June 2005 was the actual peak on a per capita basis. We see the decline here, and then we come into this period of low gas prices where we start to see this increase on a per capita basis. But with that said, the level we're at today on a per capita basis is directly comparable to late 1997. So more of us are driving, but as individuals, we are driving less. Now, this doesn't have a particular impact on how things are performing in our channel today, so I won't go into much more detail on this particular statistic, but it's something worth watching over time, especially as millennials start coming into their peak driving years as they're coming out of school, getting jobs, starting families, etc., which is a good thing. On the flip side, we have baby boomers that are retiring, coming out of their peak driving years where they're not driving to work anymore because they're retiring, and therefore they're driving overall less. The other point to make on this slide is how younger drivers today, when I say younger, 16-year-olds today, their driving behaviors versus what a 16-year-old's driving behavior might have been 20 or 30 years ago. We have consumer research that tells us that 16-year-olds today just aren't as excited to get out there and get their driver's license as maybe a 16-year-old was 20 or 30 years ago. 20, 30 years ago, the only way to go see your friends from school was to hop in your car and go see them, and today you don't have to do that. You can get on FaceTime, you can text, etc. So different ways to connect with your friends versus hopping in a car and driving. So again, those are more trends that we should be as an industry aware of long-term, looking at 10 or 20 years and how those trends will affect us 10, 20 years from now. The short-term story today is that miles driven is positive, which again is a good thing for us. When we look at the percent change or the growth rate, this is just a trended growth rate percentage chart. You see generally positive. We come into the recession, we're starting to see negative growth or declines. And then as we come into the more recent periods, we see positive numbers. If we hone in on the period from May 2012 to current, though, I'm going to change charts, but again, we're going to zoom in right here on this particular part of this chart. We can see the growth rate starting really in 2015, or if we go back to 2013, an acceleration in the growth rate. Again, this is 12 months ending September 14, for example, versus the same period a year ago. So we see an acceleration in the growth rate. But what's interesting is here in the last 3 or 4 12-month ending periods, we're starting to see that growth rate pull back a little bit. And so, we hit somewhere in the 3.7, 3.8% range as of March, but now as of May, we're at 3.4%. NPD forecasts that miles driven for the calendar year in 2016 would be somewhere in the 2 to 2.5% range. So it'll be interesting to watch this chart as we get more data and have more months of miles driven under our belt to see what this number ends up with for the year. We've had pretty healthy growth the last few years. Our expectation is it's going to be challenging to continue to lap 3 to 4% growth year after year. So where will this end up? We shall see. If gasoline prices start to trickle back up, which is the expectation, this will also have an impact on this trend. But again, the takeaway so far this year, miles driven up 3.4%. Let's look at gasoline prices for a minute. For the fifth consecutive year, the average retail price of gasoline has declined, causing an increase in demand while saving us as consumers cash at the pump. So when we look at the last 4 or 5 years on a chart, and this is just average gasoline prices for the first 26 weeks of the year, we can look at 2012, 2013, and 2014. Generally speaking, the average price for those 3 years, and again, just the first 26 weeks of those 3 years, was somewhere similar to each other. So the overall for each of the years was about the same. Last year, we saw a fairly dramatic decrease in gasoline prices. And while for 2016, there has been a slight increase in prices, if we were to look at the trend on a straight line going back 12 or 24 months, most recent period, when we compare the first 26 weeks of this year to the first 26 weeks of last year, the story is overall gasoline prices are cheaper. And the gasoline prices are 39 cents per gallon cheaper during this period compared to the same period a year ago. When we look at the amount of product supplied, which we're using as a surrogate for demand, we can see that year-to-date June 2016, demand is up 3.4%. Similarly, last year is up 3.7%. So we've had 2 years now of north of 3% growth in the demand of gasoline. Yet when we look at how much we're saving as consumers, last year at this time, spending was down almost 27%, and now this year down 12%. So the fact that gasoline spending is down 12% on top of a decline of 27% the year prior is a good thing for us as consumers. I live in Houston, Texas, the oil and gas capital of the world, and I've got a lot of friends and neighbors that work in the industry that aren't very excited about low gasoline prices as it relates to job security. But with that said, consumers overall are enjoying savings at the pump. So we have an increase in miles driven. We have gasoline savings at the pump. We're spending less as consumers. All of these things are good things for the growth of the automotive aftermarket. So 2 positive macroeconomic trends. Let's look at average price in the retail tracking service. So after increasing for the last several years, we actually saw an overall decline in the average selling price of all the products that we're tracking here at NPD for automotive. And when we look at it on a chart, looking at the first 6 months of the year for the last 4 years, we can look at, for example, 2013. And what we're looking at is we literally averaged the selling price of all tracked categories together, just to get a general sense of what's happening. So 2013, 2014, 2015, what you see is each year a step up in the overall price. February 2015 was a bit of an anomaly, this fairly large gap. We had an extremely cold month this particular month. We saw a lot of automotive batteries sold that particular month, which drove the overall average price of everything tracked up. But the general trend we're seeing for the last 3 years is an increase in average price, which is what you would expect to see. What's interesting about 2016 is, with the exception of January, every single month the average is at or below last year. In fact, if you look at June of 2016, it's almost at the level of 2014, 2 years ago. So this was an interesting trend that we came across when working on this presentation, so we did a little digging, try to understand what's going on in more detail. When we look at the 29 categories that we're tracking, we can see that the grand total overall for the first 6 months of the year is down 0.2%. Again, average price, down 0.2%. There are 15 categories representing over 60% of all the volume that we track that saw a decline in the average price. We have some categories down 0.5% or 1%. Some categories down over 16% in terms of the average price. With that said, there are some categories that saw an increase in the average price. Hand care, for example, up 7.8, lighting almost 5, etc. And you can kind of go through the list and see which categories are growing in average price. But again, half the categories experienced a decline in the average price. So we know miles driven is up, which is a good thing. You would think that would drive growth in our channel. Gasoline prices are down, saving us money at the pump. Again, a good thing for automotive spending in terms of the amount of money that I now have in my wallet, maybe to spend on my car. And the average prices are down, not necessarily a good thing for channel performance. So when we look at the results of what happened so far in the first half of June 2016 in our retail tracking service, we're calling the performance of the channel mediocre. Overall, the channel is up 1.5% year-to-date June 2016 versus the prior year. The last two periods, so year-to-date 14, year-to-date 15, both saw growth at 4% or greater. So we are trying to lap healthy growth the last 2 years this year. So when we have 4%, then 4.2%, now we're up 1.5%. It's a bit challenging to continue to lap growth like what we're seeing the last couple of years. So the growth has slowed. That's on a dollars perspective. When we look at it on a units perspective, 2 years ago we were down 1%, last year up 1%, now this year we're up 1.8% in terms of units or quarts. We equivalize the quarts on certain categories like motor oil to try to understand how much volume is moving off the shelf. It's an interesting shift in the trend that we're now starting to see. Our story for many years leading up to the last 2 or 3 years was that dollar performance was positive, units performance was negative, meaning we're selling less stuff for more money. Here in the most recent year or two, the story has been both were positive. There's been a return to miles driven, gasoline prices are cheap, overall dollars and units in our channel was positive. What's interesting to see now, year-to-date 2016, is that dollars is up 1.5, units is up 1.8. So the unit growth is actually outpacing the dollar growth. So we're actually selling more items or more stuff for less dollars. Again, going back to that average price story that we saw a few slides back. If we take those 29 categories that we track and we bucket them into 3 different what we call super categories, as we talked about, the grand total, dollars up 1.5, units up 1.8. We can look at things like accessories and appearance. So categories that fall into this bucket include things like air fresheners, interior accessories, appearance chemicals, cargo management, etc. Unit growth in that particular bucket's up 5. So discretionary categories doing fairly well from a unit growth perspective. New car sales, which we don't touch on in detail in this presentation, but new car sales have been very healthy the last few years. 2015 saw a record number of new cars sold, over 17.5 million new cars sold in 2015. So are new car sales driving some of these categories? That tends to be the general theory out there, one that we agree with. Appearance chemicals, air fresheners, cargo management, those types of categories that are really driven by consumers buying new cars, accessorizing their cars, keeping those new cars clean. So it's a good story for discretionary spend. Chemicals, additives, and fluids, basically flat for the year, up 0.3% in unit volume. Maintenance and repair, these are categories like batteries, wiper blades, filters. Units basically flat here as well. Dollars up 2.1, but units flat. When we look at the average weekly sales trended for the first 6 months of each year, going back 5 years, we can see a similar story to the average price story, where each year, with the exception of a couple of anomalies due to weather-related things, we see a step up in the overall average weekly volume sold. So we look at the last 5 years, 2011 to 2015, overall a step up in total sales. 2016, we have months that were at the level of 2015. June is an anomaly here. We actually saw the same trend we've seen the last few years, where June 2016 was above 2015. Similar to January, following the normal trend. But here in the middle, February through May, we did not see growth in our channel from a dollar sales perspective. One thing we have not touched on is the weather, and weather does have a dramatic impact on certain categories, especially batteries, antifreeze, refrigerants, etc. So I mentioned on my first slide there has been no real extremes in the weather. Let's touch on that in a little more detail. From a temperature perspective, I mentioned that year-to-date June 2016 was the 3rd warmest period on record behind 2015 and 2012. So comparing year-to-date June 2015 to year-to-date June 2012, etc., looking at the first 6 months aggregate, over 120 years of history, this is the 3rd warmest period we've seen. Every single state in the U.S. was warmer than average during this first 6 months of the year. 33 of the 50 states were considered much warmer than average compared to prior years. So a lack of extreme cold doesn't help growth in our channel. Precipitation totals across the contiguous U.S. were what I'm calling mixed. So some states did well, some states, when I say well, had high amounts of rain, some states had low amounts of rain, and the overall average put us right in the middle of the 120-year look-back period. So it's just been an average year, nothing to write home about. And again, some parts of the U.S. had more, some parts had less than average. Again, nothing to write home about as it relates to precipitation. So when we look at the dollar percent change by category, I told you overall we're up 1.5%. Half of the categories that we're tracking, which represent 46% of tracked volume, performed worse than the overall market. Washer fluids not doing so well. Antifreeze down. Those are the two worst performing categories. Washer fluids down almost 12%. On the flip side, we talked about air fresheners and discretionary spending and new car sales, etc. That category is the top growth category that we're tracking, up almost 10%, right? Just ahead of tire and wheel accessories, up 8%. Paint and coatings up 8%. So again, discretionary categories at the top of the list as far as growth goes. So we've talked about average prices. We've talked about dollar percent change, unit percent change. Let's look at the 10 largest categories that we track. Batteries is the largest category that we track. It's pushing $1.5 billion in sales for the first 6 months of the year. And it grew 1.8%, just above the overall average. Motor oil up 0.5%. The wiper category down 2.2%. So if we hone in on those three particular categories, understand that they're the three largest that we track. We can look at a category contribution index to understand the importance of each category to our channel. And so what I did to get this chart, I literally took all 29 categories, or divided the total dollar sales for all tracked categories by 29 to get an average for each category. I did an index. So batteries index over a 500. So does motor oil. So these three particular categories, very important to the performance of our channel. And there's about 9 or so categories that fall above the 100 index mark. But again, if we hone in on these three particular categories, let's look at how they've performed the last few years. These three categories alone, batteries, motor oil, and wiper blades, represent over 43% of the total tracked volume. So three categories are pushing 50% of total sales out of the 29 categories that we're tracking. So if we look at batteries, for example, the last couple of years, 2 years ago, the category grew 7.3% versus the year prior. Last year, it grew 5% on top of the 7% from the year prior. So this year, we're only up 1.8%. Motor oil saw 2 years of 2+% growth. Now we're up 0.5%. Wiper blades grew 1% 2 years ago and then grew almost 10% last year. So now the category is down 2.2%. The takeaway from this slide is that these three categories are very, very important to how the overall channel performs, and each category individually is trying to lap significant growth from the year prior, which is challenging to do, especially when a category like wiper blades that grew 10% last year. And so if we dig into each category in a little more detail, we can look at batteries. Batteries, the average selling price this year declined 2.2%, and what appears to be driving that decline in the average selling price is a shift in the mix of what's selling. This category, we break it down into grades, what we call good, better, best grades. If you're a consumer, you can walk into a retail store. You've got a couple different choices of batteries that are on the shelf, or the counter person is giving you a couple of options. They're going to present different options to you, most likely a good, better, or a best. The way we track it, we can see from a unit share perspective, the grade we classify as good grew over 5 points in share at the expense of better and best. So in this category, we've seen a change in the mix of what's selling. So that helps us understand why the average selling price in this category has come down. Motor oil, passenger car motor oil, or PCMO, average price per quart declined 1%. There are two segments that are growing in passenger car motor oil, those being full synthetic and high mileage. They're growing fairly well. We've seen north of 10% growth in both of these segments, and conventional motor oil continues to decline. Full synthetic and high mileage both saw quart price declines so far this year. Full synthetic price declined 4%, high mileage price declined 2%. In both of the segments, all of the top brands saw a decrease in the average price of what they're selling. Private label volume increased in both of these segments, yet private label pricing has also declined, similar to all the branded offerings, or at least the top branded offerings here in these two categories. This particular category is heavily promoted. A lot of oil change specials that go on and other types of promotions in store, at shelf, in flyers, etc. And so there is the possibility that the promotion timing has changed. It's possible that from a calendar year perspective, more promotions happened in the first 6 months of this year than did last year. And maybe we won't see quite as many promotions in the latter half of the year, or the last 6 months of the year. So will this trend continue of average price declines, more promotions in this category for the year? We shall see. But for the first 6 months, the story is that we've had more promotions taking place, driving down the overall average price per quart in both full synthetic and high mileage. Wiper blades. We track wiper blades a couple of different ways. We bucket them into conventional blades and into beam blades. And within conventional, we have different grades: value, standard, and premium. So value being the low end, premium being the high end, standard falling right in the middle. What's interesting is that both value on the low side and premium on the high side, we saw unit volume declines, where standard, right in the middle, grew. Beam blades, we bucket into standard and premium, low, high. Standard grew, premium declined. And so we've seen some price changes also influencing this trend. So again, our story for a while, along with other stories and other themes we've experienced, is that premium products were growing, and we're leading the growth. We're seeing a bit of a different story here in these top three categories that are driving some of the bigger picture trends from a price perspective and from an overall channel performance perspective. Quick summary. Miles driven overall, up 3.4%, 12 months ending May. But the growth rate is slowing. This is one to watch as we go into the last half of 2016. Gasoline prices continue to be favorable in terms of driving miles-driven growth, no pun intended. So demand is up, spending continues to decline. This is a good thing for consumers. The weather hasn't really helped us this year. We need extreme cold, we need a lot of rain to drive growth in a lot of categories. We haven't had that so far in 2016. So I put a down arrow or a negative in terms of the weather helping us grow. So then channel performance up 1.5%. We're trying to lap, or we are lapping, 2 years of north of 4% growth. And then large categories, again, batteries, motor oil, and wipers, are trying to lap significant growth from a year ago. The story about units being positive and now outpacing dollar growth is also going to be one to watch, because that's a shift in the tide, so to speak, in terms of the trends we have been talking about, dollars up, units down. Now we've got both dollars and units up and units outpacing dollars. And then the average selling price change. Each year, the last few years, we've seen a step up in overall average price, and now we've actually seen a pullback in the average price, again, tied to some of the things we've talked about. Could be promotion timing, but also a change in the mix of what's selling. NPD forecasts that 2016 would grow 2.7%. We're at 1.5% so far. So we will see how our forecast holds up as we go into the last half of the year. A couple of quick things on what's new with NPD before we wrap it up. We're excited to tell you about a new point-of-sale tracking service that will cover food, drug, dollar, and convenience channels. That's something that we are going to launch later this calendar year. It will be a separate standalone service from our current retail tracking service, but it is another area we're venturing into to track and will help us track a part of the market that we're not currently tracking, and again, it'll be something that will be separate from what we currently do on the automotive and mass side. We have a do-it-for-me topical report from consumer information that we've gone out to talk to consumers via online surveys about their do-it-for-me service behavior. What have you had done to your car? Why do you have certain things done to your car? Why aren't you doing certain things to your car? Where do you go and why, etc. So that's something that we've published here in the last 3 or 4 weeks, and if you're interested in learning more, please reach out to your account representative. And then we have a new service or a new product called the Market Observation Suite. So a lot of you as clients are in one particular category today. You manufacture products in 1, 2, or 3 categories. Maybe you're considering venturing into another category you're not currently in today, or you're interested in trying to understand how certain categories are performing in more detail. We have a new report available for purchase that is something that will give you a one-time deep dive into a category of your choice that maybe, again, if you're interested in learning more about a category that you're not looking at today, might help you understand better what's going on with that category. Thank you again for your time today and for joining us for this webinar. My contact information is in front of you on the screen. Feel free to reach out to me with questions or reach out to your account representative for questions or any follow-ups on this presentation. Have a good afternoon. Thanks again.